The first slide we've got is basically the data released over the European session. What caught your attention today, Darren?
Well, the biggest headline really wasn't actually, in fairness, wasn't actually out today. It was out yesterday. China cut the reserve requirement rate. That is the ratio of collateral banks have to post to the money they lend, and it cut it from 19.5% to 18.5%. That's the biggest drop, I think. I'm right in saying it, as far back as maybe 2008. What that effectively means is that the People's Bank of China is trying to add money into the system, might free up as much as $200 billion into the Chinese banking system. Interesting, though, to contrast that with their action on Friday, where they very much tightened margin trading rates that brokers can offer their clients. So tightening for private investors, trying to loosen the monetary conditions for commercial lending. However, whereas before that might have been greeted with
bullishness.
Yes, Asian equities took that the other way, and took it to mean that the powers that be in Beijing are probably more concerned about the slowdown in China than they previously thought. You remember, GDP came in below. Well, around 7% last week, in fact, and so very much on the downward leg from where it's been, and equity markets in Asia, as I say, a bit concerned about that, and the Hang Seng, for instance, Hong Kong stock market had its biggest loss in 4 months.
Understood.
On that news. Elsewhere today, we had producer price data for March from Germany. On the month-on-month basis, it looked okay. Producer prices were up by 0.1% over February 2015. However, if you dig into the data, you find that they actually fell by a much bigger 1.7% year on year. And that basically, gives further life to the idea that things are, despite there being improvements in the Eurozone, there are still big problems there, and that deflation and falling prices are still an issue that the ECB and the individual underlying economies will need to wrestle with.
Understood.
And of course, the other issue that the European Union can't get away from is Greece. The Brexit's back in focus. The problems in Greece are mounting up. Neither side seems any closer to a compromise. So the time for a deal keeps running out. Barclays says the risk of an exit is at its highest ever, including the 2012 when the country defaulted. I think I'm right in saying also that Nomura now has also gone on record as saying they think there's a 40% chance of a Greek exit. No one really knows what that means, but it's obviously unsettling times for European markets.